Hi, welcome to Money Love. It's that time of the week again. Remember, we talk about investments, we talk about loans, we talk about saving and investing money. But the thing that ties all of these things together is taxes, because the more you save on your tax, the more money you'll have in your account. Money saved is money earned. But taxes are boring, they're tedious, the rules are complicated. Nobody ever wants to get around to it until it's the absolute last day. So it's a quick reckoner on all of the things you can do to save taxes. I personally am a believer in getting help on all fronts. Although we should do a conversation on getting help on the mental health front, I think you should get help on the taxes front as well. There has been an attempt by government to simplify the taxation process, but I don't find it simple at all. I still think it's really complicated. I prefer to use the services of a CA because it just gives me the confidence that it's been done right. I would rather do it right than have errors in my tax system, right? So today we're going to talk about how we can actually manage our taxes better so that we can save more as far as taxes are concerned. Before we go any further, remember, this program is brought to you in association, in partnership with Frio. It's a brand new banking experience. It helps you manage your money better, get better credit. It helps you shop better and do more with your money. Do check out Frio as well. So it's that time of the year when we have to file our taxes. The last date is the 31st of December to file your taxes. Like I said, I prefer to use the help of a CA, but if you are someone who likes to do it on your own, please go ahead and do so. Let's just go through a basic sort of understanding of how taxation works in India, especially if you are salaried or if you're someone who makes a regular income. Now, people think that you have to pay tax on all the money you earn. That's not true. Okay, so there's the income that you earn, which could be from your salary. It could be interest you have earned on a fixed deposit. It could be some dividends you're earning from stocks that you hold. Rent maybe that's coming in from an apartment that you have. So there are the incomes that come in from various heads. These are all incomes. You might have a bank account randomly somewhere. If you haven't touched in a while, that's generating a little bit of interest on the money that it's in there. That's also an income. So you combine all of these incomes, right? So that is your first income. You have to take out all the exemptions. There's a lot of income that is exempt from tax. So income minus exemptions will give you your taxable income, which is what the taxes are actually applicable on. After that, there are deductions that you can deduct from it. So your taxable income minus your deductions will give you your net taxable income, and that's what you pay tax on as far as your slabs are concerned. So let me tell you what these three things are, right? So first, like I told you, the income that comes in from your various sources. The exemptions in this could be, for example, if you have agricultural land, the income from agriculture is exempt from tax. If you have HRA, so in your salary, that breakup under HRA, if you claim it, it's exempt from tax. All of your reimbursements, your conveyance, maybe your uniform maintenance reimbursement that your office gives you is all exempt from tax. So this is all of your exemptions. So basically you take a look at it and you take out all of those exemptions, and what you're left with is your taxable income. Then you go into your deductions. Your deductions are investments that you have made or money that you have spent that the government believes is a good thing. Once you take those deductions into consideration, then you have basically your net taxable income. So let me take you through some of those deductions that you're allowed. There's of course ATC, which is a very popular one, which you get a deduction of a total of 1.5 lakh rupees. This is your employee provident fund, your fixed deposit, your life insurance, your tax saving mutual funds, your national pension scheme, Sukanya Samriddhi Yojana. All of these things come under this one ATC category. So it really sort of jostles for space. It's not a lot really. I personally believe that the government should increase this amount much more, because it's been at this level for a very long time. And it doesn't make that much of a difference because you have so many investments, and the reason why these investments are tax deductible because the government wants to encourage us to invest more in our pensions, so that when we retire, we have money in our hands. And we don't have social security like some other countries do. So this is a way to encourage citizens to put money away for their own retirements. But it's not enough, and I think it should be a little better. It should be a slightly higher value. But Section 80C is a very popular one. And then of course, you know, there are the contributions to your house loan. There's contributions that you pay to your health insurance. These are separate categories. If you're above a certain age, then any sort of diagnostic health tests that you take as well can be deducted. There's money also set aside here for children's education, although I must point out it's not a lot. For looking after, or money that is spent in looking after a disabled person, there's some money set aside for senior citizens as well. You should take a look at all of this. It's quite extensive. Not all of it might be relevant to you, but it makes sense to read through all the fine print or to get help and get someone to do it for you. So then you have those deductions. And once those deductions are out, now we have arrived on the income for the year on which you will actually be taxed. Again, there are tax brackets, right? So you could be in the 10% bracket, the 20% bracket, the 30% bracket. That doesn't mean, let's assume, and I wish this for you, that you make enough money to fit into the 20% or the 30% bracket. That doesn't mean that all of your money will be taxed at 20%. It works in slabs. So let's put the slabs up on the screen. Again, it looks complicated, but it's not. So let's assume you're making, say, 20 lakh rupees a year, right? After all the deductions and exemptions and everything, we've wound up with, say, 20 lakh rupees. The first 2.5 lakh rupees is tax-free. You don't pay tax on it. From 2.5 to 5 lakh rupees, you pay 5% on that amount, and then it moves that way. You pay 10% on the next chunk, 15% on the next chunk, 20% on the next chunk, and that's how you arrive at your final taxable income. This is roughly how it's done. It is calculations. It is reading through the fine print. It is very, very annoying, which is why I recommend that you get help and you get someone to take a look at it, because it's also attention to detail, and not all of us are very good at it. So it makes sense to get the professionals to take a look at it. Couple of tips if you're filing your taxes, if you tend to do it yourself, make sure you're using the right form. Check everything multiple times before you send it in. Make sure you keep a copy of all the documents for yourself as well while you're submitting what you submit to the income tax department. Save everything in a file. How many ever years you can go back saving everything in a file, it's always good to do so. There is, of course, the new tax regime and the old tax regime. Again, this is a complicated choice. It's not something I can explain to you right away. Maybe we'll do another video on it. But again, if that's a choice that you'd like to make, do get professional help to look at your specific case and tell you whether you're better suited for new tax regime or old tax regime. And make sure that you do it on time. There's always a problem. This was a joke among journalists that journalists are terrible with these things, and they always file their taxes late, and they always pay fines on their taxes and things like that. Make sure you pay it on time, because you don't want to lose money on fines, and it's also, you don't want that last minute rush where you're doing it all last minute and you don't have enough sort of time to put in thought and make actual good choices. The advantage really of doing it at the beginning of the year instead of the end of the year is that then you can actually choose the best investment out of various options that are available to you. As opposed to the end of the year, I've seen people make calls and say, chalo, kara do, let's just get this done fast. That's not exactly the best way to do it, because it's still your money and you're stuck with an investment that's not great for you. So one of my biggest tip is start at the beginning of the year when you're giving your declaration to HR saying, this is what I will invest in. Start at that time and make those investments. You also have the whole year then to part with that money, as opposed to doing it last minute in the month of January and February. If you have questions about taxes specifically that we can sort of expand on in a separate video, leave your questions in the comment section. It will be our pleasure to hear from you. Remember, this has been brought to you in partnership with Frio, which is a brand new banking experience. You can get a savings bank account, you can get easy credit, and you'll also be able to manage your money better with Frio. Take a look at our previous videos that we have put up, and if there's anything else you'd like us to talk about, leave us a comment in our comment section. Thanks for watching.